The retirement mirage, a psychological condition affecting millions of investors. Most people won't finish this video, not because it's too long, not because it's too complicated. It challenges something they desperately want to believe, that everything is fine, and that's understandable. The market is near record highs and your account statement looks beautiful. The financial media sounds optimistic, your advisor sounds calm, and your neighbor suddenly sounds like Warren Buffett. Everything appears to be working, which is usually when people stop asking questions. Psychologists call this confirmation bias. The tendency to search for information that agrees with us while ignoring information that doesn't. In plain English, we love hearing we're right and we hate hearing we might be wrong, especially when money's involved. Let's be honest, nobody wants a reality check during a bull market. People don't want information, they want reassurance. They don't want someone inspecting the foundation. They want someone complimenting the paint. They don't want someone checking the parachute. They want someone reminding them the plane is still climbing, and that's where things get interesting. That's because a dangerous cocktail starts getting served. It's called the reality distortion cocktail. It contains 5 different psychological ingredients. 1. Confirmation bias. 2. Crash fatigue. 3. FOMO, fear of missing out. 4. Irrational exuberance. 5. Paper wealth syndrome. Confirmation bias says, show me information that agrees with me. Crash fatigue says, I've heard that before. FOMO says, maybe just a little longer. Irrational exuberance says, this time is different. Paper wealth syndrome says, look how rich I am. Individually, each one bends reality. Mix them together and something strange happens. Risk starts looking like opportunity. Speculation starts looking like investing. Hope starts looking like a retirement strategy, and paper starts looking like wealth. The distortion becomes so powerful that abnormal starts feeling normal. They can make a retirement account feel bulletproof right before it discovers gravity. A stock rises 250%. Normal. Investors borrow $1.3 trillion against their portfolios. Normal. 10 stocks become nearly 40% of the entire market. Normal. Some of the highest valuations in financial history. Normal. Every warning sign flashing red. Normal. Everything becomes normal until it isn't. That's the danger. The cocktail doesn't convince people they're taking risks. It convinces them risk no longer exists, and that has historically been one of the most expensive beliefs in investing. Markets rarely crash because people are afraid. Markets usually crash because people stop being afraid. That's where the retirement mirage begins. The retirement mirage is a strange condition spreading through retirement accounts across America. It doesn't show up on an X-ray. It doesn't require medication. Most people don't even know they have it. In fact, most people suffering from it feel fantastic. That's what makes it dangerous. The symptoms don't feel like symptoms. They feel like success. The account balance is up. The statement looks beautiful. The advisor sounds calm. The television people are smiling. The neighbor is bragging. The market keeps making new highs. Everything feels fine, which is usually how trouble introduces itself. Nobody stands at a market peak thinking, this feels like a terrible idea. Quite the opposite. Market peaks feel intelligent, profitable, and safe. That's why they work. The retirement mirage doesn't begin when people are afraid. It begins when people stop being afraid. Caution starts feeling outdated. Protection starts feeling unnecessary. A retirement statement becomes a security blanket. Paper. Wealth starts feeling permanent, and investors quietly convince themselves, I'm good. The problem is that confidence and safety are not the same thing. Wealth is not money. Gains are not protection. The retirement mirage blurs those lines. The longer markets rise, the stronger the illusion becomes. Investors stop asking, what if I'm wrong, and start asking, how much higher can this go? That sounds like a small change. It isn't. One question manages risk, the other chases it. One protects wealth. The other assumes wealth no longer needs protection, and every major market bubble in history eventually reached the same destination, a point where caution looked foolish and optimism looked intelligent. That's usually when reality starts getting interested. It has a long history of showing up right after people become convinced it won't. The names change, technology changes, and headlines change. Human nature doesn't, and that's when the symptoms begin. Symptom number 1. Crash fatigue. Crash. Fatigue is what happens when investors hear warnings so many times that they stop hearing them, not because the warnings disappeared, because the investors got tired. The market is overvalued. I've heard that before. The debt is too high. I've heard that before. Stocks are concentrated. I've heard that before. Something could break. I've heard that before. After a while, the warning becomes background noise, like a car making a strange sound, a leak under the sink, a smoke alarm with a dying battery. You know it's there, you just stop paying attention. That's crash fatigue. The danger isn't that people disagree with the warning, it's that they stop caring. A smoke alarm goes off once you check for fire. A smoke alarm goes off every day for 10 years, and eventually, you start pricing hammers. The alarm may still be right, you just hate the sound, now. Perhaps people say, nothing happened last time, the market always comes back. My advisor says stay the course, they've been saying that for years. Maybe, but history doesn't care how many times you've heard the warning. Reality only cares whether the warning was right, and it has a nasty habit of grading the test after you've already turned it in. Crash fatigue doesn't make investors brave, it makes them comfortable, and comfort has a long history of showing up near major market peaks. Because the market rarely rings a bell at the top, it usually hands out confidence instead. That's what makes it dangerous. Nobody was walking around saying, I think my retirement account is about to get hit by a truck. That's not how bubbles work. Bubbles feel safe, until they don't, and that's when crash fatigue hands the baton to the next symptom. Symptom number 2. FOMO. Fear of missing out. Possibly the most expensive emotion in retirement. FOMO doesn't start with greed, it starts with comparison. Somebody else is making more money, bought the hot stock, caught the rally, looks smarter, seems to have the secret, and suddenly caution starts feeling embarrassing, patience starts feeling outdated, discipline starts feeling expensive. A retiree may not even be worried about losing money, they may be worried about looking foolish while everyone else appears to be getting rich. That's when the brain starts negotiating. Maybe I should take a little more risk. Maybe I'm being too conservative. Maybe this AI thing really is different. Maybe I'll wait a little longer. That phrase, a little longer, has probably done more damage to retirement accounts than bad math. Because FOMO doesn't show up wearing a warning label, it shows up wearing success, disguised as opportunity, disguised as confidence, and disguised as common sense. That's why it's so effective. Wall Street loves FOMO, because unlike fear, nobody has to sell it to you. People volunteer, line up for it, and ask for more. FOMO whispers, look at your neighbor, look at your coworker, look at that stock, look what you missed. While you're busy looking at everybody else, you stop looking at your own risk. That's when investing starts becoming something else, something that looks suspiciously like gambling. The difference: investing asks, what could go wrong? Gambling asks, what if it keeps going? FOMO quietly changes the question, and once the question changes, behavior changes. Investors take more risk, concentrate more money, ignore more warning signs, stretch their time horizon, abandon their discipline. They convince themselves they're being smart. That's the trap. FOMO doesn't make people feel reckless, it makes them feel late, and people who feel late tend to do dangerous things. Think about every major bubble in history. The biggest buyers usually weren't the first people in, they were the last. The people who couldn't stand watching everybody else make money. The people who finally gave in. History has seen this movie before. 1. In 1929, everybody wanted stocks. 2. In 2000, everybody wanted .coms. 3. In 2008, everybody wanted houses. Today, everybody wants AI. Different decade, different costumes, same actors. FOMO isn't really about money. It's about belonging and not wanting to feel left behind. It's about watching everyone else celebrate while you're standing outside wondering if you're the only person not invited to the party. Here's the part nobody talks about. The people who arrive last to the party are usually the ones helping clean up afterward, and Wall Street has a remarkable history of sending invitations right before it starts turning the lights off. Symptom number 3. Irrational exuberance. Irrational exuberance is what happens when confidence gets dressed up as intelligence. The market goes up, people feel smart. The market goes up again, people feel smarter. The market doubles. Now everybody is suddenly a financial genius with a coffee mug and an opinion. 1. A stock rises 50%. People call it skill. 2. A stock rises 100%. People call it research. 3. A stock rises 250%. People start explaining why gravity no longer applies. That's usually about the time gravity starts paying attention. Bull markets have a strange side effect. They manufacture experts and hand out honorary PhDs like Halloween candy. 1. The neighbor who couldn't explain a balance sheet 6 months ago suddenly has a 12-point thesis on artificial intelligence. 2. Your brother-in-law, who thought diversification meant ordering 2 appetizers, suddenly has strong opinions about semiconductor stocks. That's irrational exuberance. Every warning gets mocked. Every risk gets dismissed. Every old rule gets thrown in the trash. Valuations, debt, concentration, risk and history. Doesn't matter. Reality, apparently optional. That's always how it starts. Every bubble creates a reason why the old rules no longer apply. The story changes. Psychology doesn't. Today the story is artificial intelligence, and to be fair, AI may genuinely change the world. It may become one of the most important technological revolutions in human history. That isn't the debate. The internet changed the world too. The question is whether investors are confusing a revolutionary technology with a reasonable valuation, because those are not the same thing. The internet changed everything. The investors who paid ridiculous prices learned a painful lesson. The technology survived. Many portfolios didn't. Today, some investors act as if every company connected to AI deserves any valuation, any price, and any expectation. History suggests that's dangerous, especially when margin debt sits near record highs. Some stocks have risen hundreds of % in months. Some for 9, some for 9. 10 stocks represent nearly 40% of the entire market. Valuations sit near some of the highest levels ever recorded. Yet many investors look at all of that and conclude, everything is fine. That's not analysis. That's optimism wearing a fake mustache. Irrational exuberance is dangerous because it doesn't feel reckless. It feels intelligent, sophisticated, and obvious, which is exactly why it has appeared before nearly every major market collapse in modern history. Bull markets create confidence. Bubbles create certainty, and certainty is where investors get hurt. The moment somebody becomes absolutely convinced they can't be wrong, they're usually standing closest to the cliff. The cruel part? Nobody realizes they're drinking the reality distortion cocktail while it's working. That's why bubbles don't feel dangerous. They feel normal, smart, and permanent. Right up until normal gets discontinued, and that's when irrational exuberance hands the baton to the king of them all. Symptom number 4, paper wealth syndrome. This is the king of them all, because this one feels real. The statement says, $452,000, $800,000, $1.5 million. The number looks real. It feels real. It even has commas, which somehow makes people trust it more. Here's the uncomfortable truth. A retirement statement is not money. It's a quote. A quote that assumes somebody else is willing to buy your assets at today's price. Paper wealth is wonderful until reality asks for cash. You cannot buy groceries with a 401k statement. Pay the electric bill with page 3 of your IRA summary. Hand your pharmacist a performance chart. Pay property taxes with unrealized gains, and you definitely cannot tell the IRS, please see attached screenshot. Reality is rude like that. Reality accepts payment, not confidence, not optimism, not screenshots, not unrealized gains, not vibes. Imagine standing in Costco. Your cart is full. The cashier says, that'll be $347. You proudly hand over your retirement statement. The cashier looks at it, nods politely, looks impressed, then asks, that's wonderful. Cash or credit? That is paper wealth syndrome. Feeling rich and being rich are not always the same thing. The Mirage convinces people that because the statement is bigger, they are safer, but bigger and safer are not the same thing. A taller ladder gets you higher. It doesn't make the fall shorter. During a bull market, investors start treating paper wealth like permanent wealth. Eventually people stop seeing risk entirely. That's when things get dangerous, because a retirement statement comes with an assumption, a very important assumption, that somebody will be willing to buy your assets tomorrow, at today's price. Maybe they will. Maybe they won't. That's the part nobody likes talking about. Everybody assumes there will always be a buyer, until everybody becomes a seller. Then investors discover something uncomfortable. Paper wealth depends on buyers. Money pays bills. Those are not the same thing. Investor Ray Dalio recently made what may be one of the most important observations of this decade. Wealth is not money. Most investors don't understand those 4 words until the market forces them to. History has a nasty habit of teaching that lesson at exactly the wrong time. Usually after people have become the most comfortable, become the most confident and convinced, the risk is gone. That's why paper wealth syndrome is so dangerous. It doesn't make people feel reckless. It makes them feel wealthy, and those are very different things. A retirement statement can create the illusion that you've already crossed the finish line, when in reality, you're still running the race. The cruel joke? The statement feels safest right before it's tested, because bubbles don't make people feel nervous. They make people feel rich, and that's why this symptom is the most dangerous of them all. Once investors start confusing paper wealth with actual financial security, the reality distortion cocktail is complete. Confirmation bias, crash fatigue, FOMO, irrational exuberance, paper wealth syndrome. Mixed together, they create a powerful hallucination, one where risk looks safe, valuations don't matter, history doesn't apply, and every warning sign becomes somebody else's problem, until it isn't. Why gold and silver matter? At this point, some readers may be thinking, okay, so what's the solution? That's actually the wrong question. The better question is, what is the purpose? Gold and silver are often misunderstood. People think they're supposed to outperform stocks. They aren't. People think they're supposed to make them rich. They aren't. People think they're supposed to predict the future. They don't. Gold and silver serve a much simpler purpose. They help protect purchasing power. That's it. Nothing glamorous, exciting, or complicated. Insurance is rarely exciting. Nobody buys homeowners insurance hoping their house catches fire. Nobody buys health insurance hoping to get sick. Nobody buys car insurance hoping to test the airbags. The purpose of insurance isn't excitement, the purpose is protection, and yet many investors spend decades protecting everything except the asset that matters most, their life's work. Think about that. People insure a phone worth $1,200. People insure a car worth $40,000. People insure a house worth $500,000. Yet a retirement account representing 30 or 40 years of work often gets treated as if it came with a lifetime warranty. That's an interesting assumption. Gold and silver aren't there to make you feel like a genius. They're there so you don't feel like a fool. They're not dependent on earnings reports. They're not dependent on quarterly guidance. They're not dependent on Wall Street narratives. They're not dependent on someone else's promise. They're tangible assets. They exist whether investors are optimistic or terrified. They exist whether markets are soaring or struggling. They exist whether confidence is abundant or disappearing. That's precisely the point. Throughout history, confidence has been one of the most temporary assets investors have ever owned. When confidence is everywhere, protection feels unnecessary. When confidence disappears, protection suddenly becomes priceless. That's why physical gold and silver are not designed to replace everything. They're designed to balance everything. They're not there for the years when everybody feels smart. They're there for the years when reality decides to administer a surprise exam, and history suggests those exams arrive more often than most people expect. Final warning: if your retirement plan depends on everything staying perfect, that is not a plan. That is a wish wearing a tie. Markets may continue rising. Artificial intelligence may continue changing the world. Your statement may continue growing. Nobody knows, and anyone who tells you they know exactly what happens next is probably trying to sell you something. The future has a funny habit of embarrassing people who are absolutely certain about it. That's why this report isn't about predicting the future. It's about preparing for uncertainty. Uncertainty is not a bug in the system, it is the system. The goal of retirement isn't to correctly predict every market move. The goal is to survive the moves you didn't predict. That's where many investors get into trouble. They spend so much time asking, how much more can I make? That they forget to ask, how much can I afford to lose? Those are very different questions. One builds wealth, the other protects it, and eventually every investor discovers which question mattered more. The story is never the problem. The price people are willing to pay for the story is usually where things go wrong. The technology can be real. The innovation can be real. The future can be real. The investment can still be overpriced. That's a lesson investors relearn every generation, usually the hard way. Eventually the fantasy and reality meet, and when they do, reality doesn't negotiate. It doesn't matter what the experts predicted, how many people agreed, how beautiful your statement looked 6 months ago. Reality only cares about one thing: purchasing power. Can you pay the bills? Can you maintain your lifestyle? Can you remain financially independent? Can your retirement survive a storm? Those are the questions that matter, not whether you beat the market, your neighbor made more money, somebody on television predicted the next rally. At the end of the day, retirement isn't about being right, it's about being prepared. When confidence leaves the building, it doesn't walk, it stampedes, and nobody gets a schedule for when it comes back. So, before you make your next financial decision, ask yourself one final question. Am I building a retirement plan, or am I simply making a bet that everything stays perfect? Perfection has a terrible track record, and hope, by itself, has never been a retirement strategy. When the test arrives. Nobody knows when the next market storm arrives. Nobody gets a warning. Nobody gets to reschedule it. The only question is whether your retirement is prepared before it shows up. History has a habit of giving the test first and the lesson afterward. The bill always arrives. The only surprise is how many people were convinced they would never receive one. Protection feels unnecessary right up until the exact moment it becomes priceless. If this report made you uncomfortable, good. It was supposed to. The goal wasn't to scare you. The goal was to help you see the risks that bull markets often convince people to ignore. If you've spent decades building your retirement, you owe it to yourself to spend a few minutes thinking about how you'll protect it. If you'd like to discuss your specific situation, your retirement, or whether wealth insurance makes sense for your portfolio, we're here to help. Gold Wealth Management, 866-453-7587. The market sends statements. Reality sends bills.